Ford was trading at roughly 6x free cash flow on May 14th, a multiple the market assigned to a cyclical automaker with a troubled electric vehicle division. 2 sessions later, the stock had added roughly $4 billion of market capitalization without a single earnings revision, product announcement, or buyback. What moved was not the business. What moved was the category the business was placed in. The trigger was a Morgan Stanley research note published May 15th, written by analyst Andrew Percoco. The note did not upgrade Ford's equal weight rating. It did not raise the price target from its prior level. What it did was named Ford Energy, a wholly owned subsidiary announced just days earlier, as a potential $6 billion enterprise value business operating inside a company the market was still valuing as a car manufacturer. That naming created a positioning problem for every fund that held F on an auto thesis. Funds benchmarked to auto sector weights had no mandate to hold a battery energy storage company. The note's existence signaled that at least one major institutional desk had begun repricing F on an energy storage multiple, and that signal, not the fundamental revision, is what forced the position pressure shift. Investors who had been indifferent to F at $11 suddenly faced a question about whether their thesis was still the right frame for the asset they were holding. The 22% 2-day rally was the largest for F since the March 2020 pandemic crash low. That historical parallel matters less for its return signal, 6 of the 8 prior instances clustered around generational equity bottoms, than for what it reveals about the repositioning speed. Capital that moved into F over those 2 sessions was not moving on confirmed earnings power. It was moving on a category reassignment that had not yet been validated by a single commercial contract, a revenue line, or a delivery date before late 2027. The question that repricing leaves open is what, structurally, makes Ford Energy defensible enough to hold a premium multiple, and whether the asset underneath justifies the frame the note created.
Ford Energy's structural position rests on a detail that almost every headline summary omitted. The licensing agreement with CATL, the world's largest battery manufacturer, is not simply a supply deal. By licensing CATL's lithium iron phosphate chemistry and assembling the cells at its Glendale, Kentucky facility, Ford qualifies its battery storage product for the 30% investment tax credit under the Inflation Reduction Act's 55% domestic content threshold from suppliers not on the foreign entity of concern list. Morgan Stanley called this relationship an underappreciated strategic competitive advantage. The reason that framing is analytically significant is not the tax credit itself, it is the exclusivity of the position. Most U.S. battery storage suppliers cannot legally combine best-in-class Chinese chemistry with IRA credit eligibility simultaneously. The structural barrier is not cost or scale, it is regulatory architecture. A competitor attempting to replicate Ford Energy's cost position would need either a comparable FEOC-compliant licensing structure, which CATL has not offered broadly, or a domestically developed chemistry that matches LFP's cycle life and thermal stability at equivalent cost, which no U.S. manufacturer currently fields at commercial scale. That gap means Ford Energy's gross margin projection of 25%, cited by Morgan Stanley, is not simply a function of manufacturing efficiency. It is partially a function of a regulatory position that competitors cannot immediately arbitrage away. This is where the Model E connection becomes relevant, though not in the way most coverage framed it. Ford's EV division has been generating sustained losses. The repurposing of battery capacity and supply chain infrastructure toward energy storage does not rescue Model E. The divisions remain separate. What it does is convert a stranded capital position into a productive one, with a customer base, data centers, utilities, industrial buyers, whose demand curve is structurally disconnected from consumer automotive cycles. Morgan Stanley projects 38% compound annual growth in domestic energy storage deployments through 2030, reaching 279 gigawatt-hours, driven substantially by AI data center load growth. Ford Energy's 20 gigawatt-hours of annual production capacity, once operational, would represent a material slice of that addressable market. But the moat that makes 25% gross margin plausible is the CATL licensing structure, and that structure has never been stress-tested against a CATL competitive pivot, a regulatory reinterpretation of FEOC compliance, or a renegotiation at contract renewal.
The relative value frame is where the allocation decision becomes most exposed. Tesla Energy is currently valued at approximately $30 billion on a 30x multiple of its projected 2028 EBIT. Morgan Stanley's base case for Ford Energy assigns a $6 billion enterprise value at 17.5x the same year's projected EBIT, roughly $350 million. The bull case reaches a theoretically higher figure, but the base case is the working number that repositioning capital is acting against. The multiple gap between 17.5x and 30x is not arbitrary. It reflects the market's current read on whether Ford Energy is a standalone energy storage business or a subsidiary embedded inside an auto-cyclical parent. That parent structure is the discount mechanism. A fund buying F for Tesla energy-style exposure is not buying a pure-play energy storage asset. It is buying that asset wrapped inside Ford Blue, Ford Pro, a pension obligation, a 4.4% dividend yield, and a consumer automotive cycle. Each of those layers adds correlation to macroeconomic variables that pure-play energy storage investors are specifically trying to avoid. The 12.5x multiple gap between Tesla Energy and Ford Energy's base case is not primarily a growth differential. It is a conglomerate discount applied to an asset that cannot be separately traded. That discount closes only if Ford Energy is eventually spun out as a standalone entity, or if institutional capital decides the energy storage exposure is large enough relative to Ford's total enterprise value to justify reclassifying the whole. Neither condition has been signaled. Morgan Stanley did not upgrade F's equal weight rating or revise its prior price target, meaning the desk that created the thesis has not yet confirmed the multiple re-rate on the parent stock. The participant timing structure here is observable. The Morgan Stanley note published May 15th represents the first institutional desk to formally price the energy storage frame onto F. Retail options activity surged the same session, suggesting that the second wave of capital entering the trade was following the institutional signal, rather than independently assessing the valuation. General Motors moved 3% on the same day, a sympathy read from auto sector ETF rebalancing, not a direct Ford Energy competitor response. Tesla was essentially flat, which means the market did not yet price Ford Energy as a competitive threat to Tesla's storage business. The participant who entered F at roughly $13.60, the approximate spot price after the two-day rally, is now holding an asset that Morgan Stanley values at a price target set before the move, inside a subsidiary whose first revenue does not arrive until late 2027, against a pure-play benchmark trading at a multiple Ford's parent structure cannot currently command.
The most analytically precise signal in the entire two-day event is the one that received the least coverage. Morgan Stanley published a note assigning $6 billion of potential enterprise value to Ford Energy, while simultaneously holding its equal weight rating and leaving its price target unchanged. That combination is not a clerical oversight. It reflects a specific analyst judgment that the energy storage thesis is real enough to publish, but not yet validated enough to stake a rating change on. The institutional capital that moved first on May 15th was acting on the thesis, not on the upgrade. That distinction defines who is most exposed if the thesis does not develop on schedule. The vulnerability ranking among participants who entered after the note is structured as follows. Retail buyers who entered on options on May 15th, when open interest surged visibly, paid for optionality at elevated implied volatility, with a payoff structure that requires meaningful appreciation before late 2027 delivery dates materialize into revenue. They entered latest, at the highest price level relative to the pre-note base, and their position has the shortest effective duration before conviction must be renewed. The institutional capital that moved earlier in the session, presumably on pre-publication awareness or rapid note processing, entered at a lower effective cost basis and holds a longer duration thesis. Barclays, the countersignal, called the AI trade overdone on May 16th, and the sell-off that followed is observable. But Barclays also noted Ford's ability to tap meme market spirits, which means even the bearish read acknowledged that the category reassignment had taken hold at the retail participation layer, independent of fundamental validation. The resolution condition for the thesis is not a rating upgrade. It is a commercial contract announcement with a hyperscaler or large utility, which Morgan Stanley assessed as having a fairly high likelihood of occurring within months. If that contract materializes, the participant timing asymmetry narrows. Institutional holders get confirmation, retail holders get price appreciation, and the multiple gap to Tesla Energy's 30x benchmark begins to close on justified grounds. If first deliveries arrive in late 2027 without a major commercial anchor announced before then, the position pressure on late entrants does not reverse, it compounds, because Ford's parent structure continues generating auto-cyclical correlation that energy storage buyers did not price in. Bill Ford's purchase of 140,000 Class B shares at $13.8175 in February and March represents the one insider signal predating the rally. But that entry price is now roughly 40% below spot, meaning it confirms directional conviction without informing the current entry's risk structure. The question the rally opened, whether F deserves a storage premium or remains bound to an auto multiple, will not be answered by the note that created it. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.